Welcome back to our series Endowments Unfiltered. Last week we covered how exactly you can move forward if you got an endowment policy that's not working for you. This week we promised we're going to go into how else can we structure our wealth plan to still include protection and growth and not necessarily be under the endowment structure, right? Because we have different philosophies. There's the people who are for it, for endowment policies, but we've met also quite a number of clients who are looking for an alternative way. So in this video, we're going to show you how you can transition into planning your wealth and making the protection and investment separate. Again, we believe it's important for you to know all that is out there so you can see what is best for you, because at the end of this series you can see, does endowment policies work for me, does separating work for me, or can I have a combination of both? Because it all depends on what is the overall goal, what is your overall vision, and what it is that you're comfortable with. In a previous video, still on this series, we've spoken about how endowment policies are structured. And you understand that endowment policies are hybrid products that combine protection and savings. So it's like a two-in-one, right? So what about if you want to separate? You do not want the hybrid structure. You want to take control of your protection and take control of your growth. How do you best go about it? So remember, it's a combination of protection and investing. So when it comes to protection, we are going to use a pure life product. Again, pure life product comes in two ways. There's pure whole life cover, which lasts the whole of your life. As we had mentioned also in some previous videos, which you're going to link down below, pure whole life products are very good for protection in the short run and inheritance planning in the long run. Especially if you have young children, you need to make sure between the age of 0 to their early 20s, they're taken care of no matter what. And then we have term life, pure term life covers, because term life protects you for a specific period of time. And term life is usually used for, in the case maybe you're protecting your family against a loan, because a loan has a starting point and an ending point, or you just want something that's extremely affordable because on the side you do have your growth journey and you have your growth plan, and you're like, you know what, I only want protection for the next 20 years. After 20 years, I do not require any protection. So depending on your situation, it's up to you to decide which one you're going to take. Is it pure term or you're going to take pure whole life? With a pure life cover, that means you're taking life insurance without the savings element, unlike what the endowment policy had. So with this one, you're able to get a much bigger benefit for a smaller amount because it is only catering for protection. It's a pure risk product. So that means that there's no additional investment, so the premiums do not have to go as high as an endowment policy. So because this one is just a pure, almost like a vanilla product, right? As simple as they come. So it doesn't have any extra savings, it doesn't have any extra benefits. It just still protects you in the case of a death, in the case of a critical illness, in the case of a disability. The only difference is the term. One covers you for the rest of your life and another one covers you for a specific period. We spoke more about these covers and the difference, and we're going to link it down below in a different video. We are shifting from hybrid to separating life insurance and investing. So we're going to start with life insurance for protection. So when you use a life insurance, we're talking about using a pure risk cover, a pure life cover. And this pure life cover can come in two ways. This could be a pure term life or a pure whole life. And remember, this pure life cover has no savings element. This is why it is so affordable for a big level of protection. So the first point is, how much cover do I need? what is the level of protection it is that I require, and then now getting a cover that makes sense. And remember, there's two ways of going about it. There is, first of all, as I said, pure whole life. Pure whole life works for the rest of your life. It actually covers you for the rest of your life. You can pay for a short period of time, maybe for like the next 20 years, the next 10 years, 15, whatever it is that is comfortable with you. But there's definitely going to be a death payout, because I mean, everybody's going to go down that direction. So pure whole life is really good for protection in the short run and inheritance planning in the long run, especially for people who have young children or you're planning to have kids. This can be really, really good, because children require protection, especially between 0 to at least their early 20s, so that their lives are not interrupted. And if you're someone who does not have children and you're planning to have children, because this is a permanent cover, and if you get it right now, it does not matter when these children will come, you're still going to be protected for that period of time, for as long as you live. So at least no matter when the children come, you're still going to be protected. So you don't have to wait until the children come, because at that point you'll be older, and life insurance, as you know it, is dependent on age. And secondly, we have pure term covers for people who just want a cover for a specific period of time. We have people who are maybe currently in their investment journey, and they're like, I just need protection for 20 years, maybe to take care of, my loans. In the case I was to pass away, I don't want my family to be burdened by loans, because, with loans have a beginning and an end time. So again, when it comes to whether you're going to pick a pure life term or pure life, whole life, is up to you and your goals. But again, we have done this video, and we're going to link it in the description box below. We've already gone through life insurance as a protection plan. Remember, we are choosing to go against the hybrid route, and we are creating our own structure. So that means separating protection and investment. So now we need to open our investment account. Again, you have to start with the end in mind. What exactly do you want to achieve? What are your numbers? So when it comes to investment accounts, you can open now like a money market fund account or a trust fund account. Again, we're going to link everything below so that you can even get to understand this even more. And also, if you're not going to open the investment accounts and you want your own portfolio for bonds or the stock market, you can also do the same. Because remember, what is the goal? Growth. Right? So we're opening our investment accounts, we're putting money in our investment portfolio so that we can have that flexibility of putting money aside, being able to control what goes in, and even if now life happens and we're stuck, we can take a bit of a break and continue where it is that we are left off. So we are able to maximize growth, because remember, when you open, whether it's the investment account or put money in a proper investment portfolio, it does not have a protection plan, or it does not have part of it being life insurance, because remember, we have separated it. So we're going to focus on strictly growth, right? Again, when it comes to this part, one thing that is going to be very helpful for you is also to get to understand how to do your investments well. Because as part of an investment to yourself is just to understand how money works. So if you're going to go down this route, you have to know how to manage your portfolio, or at the very bare minimum, or at least have someone who's able to guide you so that you can be able to achieve your overall goal. And another thing that is also important in this stage is to be as disciplined as possible, because remember, there's so much flexibility. You have access, but let your goal determine your discipline. You want to reach X amount in the next 15 years to take care of your child's school, or for you to buy a home, or to take care of your retirement. So you need to make sure, if I plan to put X amount every single month, every quarter, lump sum, you need to go about it that way. Never withdraw an amount of money just because of lack of discipline. Because at the end of the day, if you do this, it means you will not have money, right? So please be disciplined when it comes to your investments, so that you can be able to get the best growth possible. So we have seen how structuring, separating the protection and investment can look like. But exactly what are the advantages, of an endowment policy for people who want to go down this direction where you structure your own plan? So first of all, flexibility. So remember, with this plan, you can keep on readjusting your investment portfolio to match the market conditions or even where it is that you are at in life. So for example, at that point, say you have lost your job, you might stop contributing because there's no income, but the investment portfolio will still grow, right? And then you can catch on when you get your money back, when you start maybe having another job or you start a business and there's a sort of income. So remember, there is flexibility when it comes to how can I adjust. And also, in the case I need access to money, I have access to money because of how it is that we've structured it. I know that I have an emergency fund, which is part of the overall portfolio, and I need money for an unforeseen circumstance, I'm able to pull it out. The second advantage is control. By separating insurance and investment, you have more control in your hands. That means you can structure your investment the way you want it. You can structure your insurance the way you want it. You know, the way with endowment policies, we say you have no control over how the insurer chooses to invest. But right now, because you've decided to separate the two, you have control and you know and can choose what it is that you want to invest in. And at the same time, you can continue monitoring and readjust it to make sure that it's aligning you with your overall goal. And also the same thing when it comes to life insurance and protection. You also have some level of control in your hands because you know how much exactly you're putting towards protection and how much premium is going to give you what level of protection. So remember, by separating the two, you have control. So firstly, we said flexibility, and secondly, we have control. And last but not least, we have cost efficiency. By separating the two, it means that there's no extra management fee of managing the investment or the savings plus the insurance under one product. And by separating, that means with the life insurance, you're able to minimize the cost and maximize the benefit. Because remember, with a pure life cover, it doesn't have the extra benefit of the savings. So you're just getting it for what it was meant for, protection. Very free, very clear, and it does not have a lot of complications. Very, very simple to use and to understand. So I'm putting this money aside for this level of protection. You don't have to be wondering in your mind, how is my money growing? So look at it this way. I always say look at life insurance as a subscription for protection. So you're putting this amount of money every single month, and in return, you're getting a protection plan. And again, as I said, it's the most affordable way of going about it, just getting a pure life product. And then even now when it comes to the investment, remember, by separating, you're also minimizing the fees and now focusing on growth. So at the end of the day, you end up spending so much less, and at the end of the day, you get more protection and you get a bigger return on investment. The fourth advantage is transparency. By separating the two, it's very clear what each goal is. Remember, insurance for protection and investment for growth. So by being able to separate, we are able to track the investment growth and to adjust it if need be. So by that, it just creates a very clear picture. It's very clear to see the numbers, how the growth is happening and how the protection is happening. And again, making sure that everything is aligning to our overall goal. Advantage 5 is avoiding lock-in periods, especially when it comes to the investment or the savings element. The moment you have an endowment policy, because it's a combination of a life insurance and a savings, it means even your savings cannot be accessed in the case of an emergency, or you cannot even break it down, or you cannot even halt it in the case you do not have a job. But now, when you separate the two, it is very clear that, okay, I have a life insurance that is meant to protect me over this period of time, but it will not affect your savings. It will not affect your investment. So you are able to adjust when need be. The sixth advantage is independence from insurance companies, because remember, endowment policies are bundled. That means there's the life insurance, which is combined with the savings or investment element. And again, the investment component is going to be tied with the insurance performance. So if there is underperformance, that means that you have no choice. There is no way that you can get out of it. But the moment you separate, it means that you have nothing to do with how the insurance performs. You have control. You have the ability to change when need be, when now there's maybe new products in the market, investment product in the market, and you have that flexibility to be able to pick what is good for that period of time. We've spoken about the advantages. Could this plan have a disadvantage? So I'm going to share with you a few disadvantages that I've been able to observe so that you can know how you're going to manage yourself. Again, also to be objective, when you're looking at comparing the endowment policy and also the combination of a pure life plus a pure investment, right? So remember, number one, the disadvantage is loss of convenience, because with the endowment policy, it's 2 in 1. That means you only pay one premium and you forget about it, and the underwriter will do the rest, right? So your job is just to think of, okay, I need to put my 10,000 a month, I need to put my 30,000 a month. But you see, when it comes to now you separating, you're going to have multiple accounts, right? Because again, you're going to have your separate pure life cover. That's a separate account by itself. And then you're going to have your separate investment plan. So that means that now you have to be more hands-on when it comes to now having this plan, because you have to be like, okay, out of that 30,000, I'll send 10,000 towards the protection, which is the life insurance, and then this other 20,000 or 30,000, I have to figure out how I'm going to divide it so that I can make sure that I get my long-term and my short-term goals. So lack of convenience is a disadvantage if you are going to look at it from that angle. Second disadvantage, complexity in financial planning. By you separating investment from insurance, that means you have to have a deeper understanding and deeper knowledge when it comes to the financial markets. You need to understand fully how investments work, or at least be on the journey of understanding how investments work, and also how different life insurance products work. Because remember, this could be overwhelming for some people, especially if you do not have the energy and the time to do that deep research. Thirdly, and this is a very hot one, yeah, behavioral risks. Right? You see, with endowment policy, because of how it's been structured, you cannot pull out the money just the way you feel like, just the way you want. So if you lack discipline, that means you're not going to invest regularly, or you could have invested and put the money aside, but you end up touching this money. Right? For example, you've put this money aside as your child's education. But then if you touch this money, it means by the time your child is going to school, they are going to have no money. So it's almost like it would even have been better if you even had something through the endowment policy. So if you're someone who lacks discipline and you feel like this is something that is a challenge to you, you either have to work on it, or now you might have to now go down the endowment route. So again, at the end of the day, it's up to you to make that choice, because discipline is an internal thing. How exactly can you transition from an endowment policy to a separate life insurance and investment plan? And this is because there's some of you who feel that maybe the plan that you currently have is not for you. And we have already addressed that in the previous video. So first of all, it's important to be able to evaluate what you currently have, because it will not be smart for you to transition before understanding where it is that you're at and now creating a plan for what next. So it's important to evaluate what exactly you currently have. So that you can know how much fees, how much are the penalties, even if you're to surrender, how much will you be receiving? If you're going to reduce it to a paid up plan, how does that look like? So that now, even as you are deciding what is the level of pure coverage that you're going to take, you're coming from a place of knowledge, right? Of what exactly it is that you currently have. So again, it's always important to start with what you know, and then you go to the next level. Now you've already evaluated your policy. Now it's time to now get your pure life product, your pure life cover, especially if the protection you have is inadequate or extremely expensive, because we have seen the way endowment policy, because of combining the two, it might be hard to get adequate protection for the amount of money it is that you are contributing. Because always remember, rule of thumb is at least 10 times your annual income. To get 10 times your annual income using an endowment policy might end up being expensive. So if you've already evaluated and you're like, you know what, I need to move forward with my protection plan, it will be good now to get your pure life cover, whether it's now through term life or a pure whole life, depending on what is your eventual goal. Do you want to just protect for a specific period of time, or do you want to protect for life and eventually leave an inheritance for your children? So when that has been set up, you would have already started with your protection journey, and you know that no matter what, at least in the case anything was to happen, my family is taken care of in the case of a death, or even I am taken care of adequately in the case of a critical illness or a disability. We are now done with creating your protection plan, right? We have now set up your pure life cover, and we know that your family and you are protected no matter what. Now, let's not forget that we also have to look into the growth aspect, because remember, we are separating protection from investment. So now you have to open investment dedicated accounts. And this is now in line with your overall goal. For example, you're planning for your child's education. Have to start with the end in mind. Say your child is 2 years right now and you want to plan for their university. So most probably they'll be going to university around the age of 18, 19. So let's look at about 16-year plan, right? So that means you have to open a dedicated account for that particular goal. And because this is a long-term goal, you are able to even take a bit more risk. Or if you do not have the money to start with, you can just start small, maybe even a money market fund account or a trust fund account. Again, we're going to link that below so that you can understand better how you can structure your child's investment or education planning using a trust fund account. Because at least you know that over a period of time, you can be putting some amount of money, or you can eventually even buy bonds to be able to get to your goal, right? And also, the good thing is that now you can have separate goals for separate situations. So yes, there's one for your education, but maybe you also have a goal for, building a house. So you can have a separate account for that. That is strictly dedicated towards the house. Again, I'm such a big believer of having separate accounts for separate goals. And you can say, because this one, I'm looking into maybe building my retirement home in the next 20 or 30 years, you can be able to now look at the time period and be able to decide on the investment that you can put aside. Again, if you're not very conversant with investment, I'll advise you to start learning. There's so many great places you can start learning investment, or you can sit down with a financial advisor to help you. And if you don't have a financial advisor, you can reach out to us and we can be able to connect you with someone who can help you with your investment portfolio. We mostly help you with your protection portfolio, but we partner with amazing financial advisors who can create a structure just for you. Lastly, let's not forget monitoring and evaluation. So it will be important to be checking out your life insurance policy regularly and also your investment plan regularly, because remember, your life is changing. Life is a journey. And maybe right now you started as single, but now you have a child. So most probably the protection needs will go higher. It will be important that at that point in time to be able to increase your protection needs. And also, depending on the number of goals or the type of goals that you have, you will have to be keeping your eye on your investment portfolio so that you can readjust it if need be. There we have it. We have gone in depth on endowment policy as a hybrid product, a hybrid of an insurance and an investment or savings. And also we have looked at how would it look like if you separated the two, the insurance and investment. Again, remember, it's so important to understand who you are. It's important to understand your level of discipline. It's important to understand your level of knowledge when it comes to financial planning, and also where it is that you need help, because we all have different school of thought and we are all different, right? It's so important now to pick what works for you. I've said over and over again, endowment policies don't work for me, but it works for other people, right? But I always say it's also important, even as you're making the decision, to understand what you're getting yourself into so that you don't get buyer's remorse. There's nothing worse than starting out with something and then 5 years down the line, you feel bad for the decision that you made. So this series was mainly for you to understand how endowment policies work and to understand how the structure of separating the life insurance and investment works, and then pick the one that works for you. And there's some people who will even mix both. I mean, it's up to you. It's up to your goals. I don't have your goals. I don't know what your goals are. I know what my goals are, and I've structured my finances to be able to match that. And I really hope that you have been able to get as much knowledge, as much information as possible. And we're also looking forward to getting your questions, getting your comments. And one thing I'm going to do for you, I'm going to do a review. I'm going to do a case study so you can see side by side with the same insurance company how endowment works versus separating the life insurance and the investment. side by side. I know we have been doing reviews of life insurance policies for a long period of time, and a lot of you have asked if we could do reviews on YouTube regarding the life insurance policies. So I'm still thinking about it. So don't forget to like, to subscribe, and put the notification bell, because I might just have said yes. So don't miss next week's videos, where we're going to go deeper into case studies to understand if this is for you.